Hi, my name's Leon Rowe, currency trader and trading coach at trading180.com, and welcome to this week's supply and demand, Forex, gold, and S&P fundamental and technical analysis for the week ahead, starting the 16th of November 2025. Hope you all had a great trading week. And getting into the week ahead, and this is from Trading Economics, and it says updates on the schedule of US economic data will take the spotlight after its prolonged government shutdown ended, set to offer fresh insights after private surveys painted a mixed economic picture since October. Confirmed private releases include flash S&P PMIs, existing home sales, the NAHB housing index, and the weekly ADP employment aggregate. On the monetary policy front, minutes from meetings by the Fed and RBA are awaited. Flash PMIs will also be the focus in the Eurozone, the UK, Japan, and Australia. Meanwhile, Japan will post its third quarter GDP and October inflation rate. Lastly, Canada will update its CPI, and GDP reports are expected from Switzerland. So, lots going on this week and should be some market moving news. So, getting into risk sentiment, and it's important to understand risk sentiment when it comes to understanding where money is flowing into and out of, right? And so, we're looking at the top left hand side, which is the VIX volatility index, but it's also a measure of risk sentiment, risk off, meaning that investors will tend to go into safe haven assets like gold and currencies like the Swiss franc, not so much the yen over the past couple of years, although historically it has been a bit of a safe haven currency, as well as the US dollar as well. And the euro has had its moments in terms of safe haven plays. But in the risk on environment, it's more about yield returns. So interest rate differentials, who's got the higher interest rate, who's got the lower interest rate, and more crucially, who is hiking, which central bank is hiking, holding, or cutting rates. And at the moment, according to the VIX, we're at 20, which is a bit of a line in the sand between risk on and risk off. The higher we go above 20, it's seen more intense risk off, and below 20 would seen as a bit more risk on. And so that's kind of confirmed when we kind of confirm risk off with other asset classes like the S&P. So the S&P, if the S&P is falling to a degree where it's not just 1 or 2 days, it's an overall trend, then you can kind of get a picture as to what is happening from a price perspective, but also as well what's going on in the market. And so just because you have a market that is falling, the S&P is maybe falling, doesn't mean that it's profit taking, or does it mean that there's a reversal, right? So the markets, and looking at the major publications like Bloomberg, Reuters, the Financial Times, will also tell you what the market sentiment really is. And at the moment, the headline really is about Fed doubts grow over December rate cut with Kashkari on fence. And we'll talk about that in a sec because that covers really the dollar. But overall, I don't think necessarily it's a major risk off sentiment event, although yes, we are seeing pull back a little bit. I just think that maybe the risk off narrative of the Fed holding rates is quite weak, to be fair, in terms of what risk off really is. But the S&P does move over the medium to long term, and is highly correlated to interest rate cuts, holds, and hikes. And so kind of like a hold in interest rates from the Fed would probably lead to a bit more profit taking. So we are seeing the market move to the downside, but I don't think we're necessarily in a severe risk off environment. Gold again, you can see here kind of pulling back a little bit, and again that's really due to the Fed holding or potentially holding rates. And again, we'll get into that in a sec. But if the Fed are seen as holding rates, then that should strengthen the dollar, and gold will typically fall in that environment. Gold and the US dollar have an inverse relationship, and bond yields will typically confirm which way bond traders think interest rates are going, right? So rising interest rates in the future will mean that bond yields will go higher, and vice versa. If the bond traders think that uh, interest rates will go lower, then yields will typically follow that. And again, that's not day to day. That's more over a weekly or monthly time horizon. So overall, I think that the the market is in a little bit of a risk neutral state. I don't think it's necessarily risk on or risk off or severe on or risk off. There's reasons to buy or sell. There's reasons to be a bit defensive or still take a bit more chance, and looking for higher yielding assets. And so, looking at, in fact, the US dollar, and really currencies are kind of driven, again, over the medium to long term, and even in the short term to certain degrees. But short term is more driven by things like liquidity, algos, short term trading, positioning, end of month flows from banks and things like that. In terms of short term price action, but over the medium to long term, you'll see where markets typically go when you look back on what central banks were doing with interest rates. And so the Federal Reserve at the moment, the expected move at the moment is that the market is actually split between rate cuts and a rate hold. And really, the market says here the market is evenly divided, reflecting recent Fed infighting. Traders are waiting for clear guidance ahead of the December 10th meeting. And so, really, the Fed, and I was been saying this for the past week or two, is that the Fed are really looking at potentially looking to hold rates because they haven't got enough data due to the government shutdown. And so you've got here from Bloomberg, it says the Federal Reserve policymakers are flying blind after the US government shutdown starved them of crucial data, and the uncertainty is testing the nerves of investors. A sudden bout of risk aversion took markets, leading to a sharp plunge in some of the year's highest flying stocks and worsening a recent slump in cryptocurrencies. The weakness in the market is attributed to the dwindling probability that the Fed will reduce interest rates again in December, with swaps traders pricing in about 50% chance of a cut, down from 72% a week ago. So 72% chance a week ago that the Fed were going to cut rates, and now it's about 50% chance. And the more that those cuts get priced out, is the more that is likely to be profit taking on high yielding assets, because money can then maybe flow back into the dollar from the stock market, because of course, if you can hold the dollar and get a return rather than holding maybe higher yielding but riskier stocks, investors typically want to go with the safer play, right? Or they may want to go with and diversify away from maybe just always going for higher yielding assets, and kind of diverse their portfolio, right? So from that perspective, it does look like the narrative is that the Federal Reserve may look to hold rates, right, rather than cutting rates. And so that should be supportive of the US dollar. So for me, I think technically this is actually a really nice area to start to look for a buy trade if, again, the data either shows that the um, inflation is either stickier, or not necessarily coming down as fast as the Federal Reserve wants, and also as well that employment is stable, right? Unemployment is not a problem. Employment is potentially rising, and there's no necessarily structural issues in the economy is doing okay. That would cause the Federal Reserve to look to hold rates, and then a holding rates would basically mean an appreciating dollar. So we've seen the dollar overall, and this is the equally weighted dollar index. So the dollar equally weighted against the euro, the pound, the yen, the CAD, the Australian dollar, the New Zealand dollar, and the Swiss franc. We've seen 1, 2, 3, 4, 5, 6, 7, 8 trading days into a level. And so for me, when you get that kind of move, it's not sustainable, right? You're going to get at least some green day. Now, for me, again, the move to the upside will totally depend upon the data or the lack of data. So, lack of data meaning that if the Fed aren't clear on what is going on, aka they're flying blind on why they should cut rates, then the default position for the Fed is that they're going to hold rates. And so I'm going to be probably a bit more long on the dollar until one of those two scenarios goes against me. So that's just where I am with the US dollar. So for me, dollar buys at the moment, I think, is a decent chance. I mean, you can look for sells if prices do move to the upside and somewhere around here on the uncertainty, but I think the dollar maybe should be supported, or if it comes down a little bit more as maybe the probability of interest rates being cut becomes less and less, then that's for me an even more bullish sign that to go long, because we're diverging where you've got rate cuts being priced out, but yet you've got the dollar depreciating. That is a divergence that I am interested in to the upside. So that's where I am with the dollar. Looking at the euro, and the euro, again, I think if there's dollar strength coming into the market, I think the euro is likely to weaken. So we've seen the euro hit these highs. When we zoom out, the euro hasn't hit these highs for several years, right? It's been over a decade overall. So I think there's the potential for prices to move to the downside based on not necessarily euro weakness in terms of rate cuts, because it says here that the next move is expected to be a hold, and there's a 71% chance of a hold. And although there is some dovish pricing, the majority of economists expect no immediate change. So why would I necessarily be a look for shorts on the euro? You would look for more buys, and I agree, you can look for buys on pullbacks, but I think there's also an opportunity to look for sells on the euro technically, um, when it comes to but more when it comes to dollar strength rather than euro weakness. So a stronger dollar potentially would mean that the euro would move to the downside, as they typically do move inversely. And so if I'm betting on dollar strength, then I would expect the euro to weaken. And again, the euro is at a nice place up at these highs to look for shorts. So euro dollar, you can already guess that I'm going to be looking for short trades this week. Looking at this fundamentally, the Eurozone's perkier economy masks stark divide on growth. So it says here that robust economic growth in the Eurozone is concealing a divide that has almost half the bloc stagnating or shrinking, a worry for the European Central Bank. Data shows that countries representing 49% of the currency union's gross domestic product failed to record any expansion at all during the third quarter, period, with Germany and Italy stagnating. And the European Central Bank is monitoring the disparity in growth rates, with officials saying they must pay attention to the heterogeneity of the growth rates as they assess downside dangers to inflation. So basically, they're just watching the data. They're looking at the details of the data, and they don't want necessarily a lopsided recovery where you've got certain eurozone countries supporting others, because you need the eurozone as a whole, all 26 or 27 countries, to kind of grow together, right? If you have some growing and some stagnating and some shrinking, then there's going to be issues there in terms of interest rates, because do you cut does the European Central Bank cut interest rates, or to help the members or the countries that are struggling? But at the same time, you don't necessarily want to cut rates when there's other countries in the eurozone that are that don't need to be helped, or doesn't need necessarily to be cut, right? Because then you might fuel inflation. So the eurozone isn't all a bed of roses. So from that perspective, I think overall, I think it's going to be hard, or might be a bit tougher for the euro to kind of break to new highs at the moment. So I do think that there's potential for downside on the euro. Looking at the Japanese yen and the Bank of Japan. So last week I did think that the yen was a buy. That turned out to not be the right call. As I was in the trade, I think on the Monday it did look like the reports were coming out that the Bank of Japan were looking to be a little bit more hawkish. But by the middle of the week, as I got into I got into a pound yen trade. The sentiment kind of turned against the yen. So that trade ended up being a break-even trade, and I'll get into that a bit later. But for me, I think reading the latest reports, it doesn't look like the yen is going to be a buy anytime soon, unless there's going to be some major changes. And so it says here Japan's slumping currency intensifies debate over intervention. So it says here traders are skeptical that Japan's new government will intervene to shore up the yen as the currency slumps. Officials would be buying yen when Prime Minister Takeachi signals her desire for a slowdown in rate hikes, and her plans to boost spending are fueling the yen's weakness. So any intervention would risk depleting Japan's foreign exchange reserves and may not be effective without interest rate hikes, which are uncertain due to Takeachi's cautious stance on monetary tightening. So you've got two things going on here. You've got the fiscal policy, which is the Japan's government. Their policies are basically counter to the Bank of Japan's policies, and the Bank of Japan's policies is literally to try to potentially hike rates to try to get inflation down. But the Japanese government, their policies are really to kind of support the economy, and what they don't want is for borrowing and lending costs, interest rates to move to the upside, right? They actually want interest rates to stay low and where they are, so they can help boost, economic growth. And so that is really the issue, around the Japanese yen. And so I think that's likely to remain on the weak side. Now, I'm not saying that prices are going to continue to go lower, right? And the index is going to continue to go lower. If there is a pullback, I do think that any pullback should really be shorting opportunities on the yen overall, until really the Bank of Japan get either really really hawkish, or the government maybe have a change in heart, or their fiscal policies kind of match what the Bank of Japan want to do. But as long as their own kind of opposing views, I would say that the yen then continues to be a sell. It doesn't really matter how much the Bank of Japan wants to be hawkish at the moment. It doesn't really seem to be having any kind of effect on the yen. Of course, there is data that may, prove otherwise, but until I see evidence of that, I think the path of this resistance continues to be to the downside on the yen. And looking at the pound, and you guys know who've been following me for a while, the pound has been a sell. Been short on that pound for a while in terms of a short bias. I did get in short again this week, but it was against the weakest currency, unfortunately, which was the yen. So again, that was a break-even trade, but the direction for selling the pound, I think, was correct. The Bank of England, the next move is likely to be a cut, and the odds are 93%. So that's been kind of now priced in, and the market is strongly pricing in a cut, reflecting UK economic weakness and political instability. So with the UK, there's a report that says the UK budget bodes poorly for the pound no matter what. So the budget may spell bad news for the pound, regardless of whether Chancellor Rachel Reeves bids or Rachel Reeves's bid to balance the books keeps bond traders happy. A senior portfolio manager at Allspring Global Investment finds it difficult to make a compelling case that the budget is positive for the pound due to weak growth and falling inflation. The pound has been in decline for months against major peers, with a trade weighted gauge of strength recently hitting the lowest level since January. Mid-week business investment, rising unemployment and slowing growth. So there's that. And I know the budget is supposed to be addressing those economic issues, but it doesn't seem like it is. And then on, I think it was Thursday or Friday, I think it might have been Friday, we got this. The headline was that the UK markets tumble as Reeves U-turn or tax U-turn fuels budget jitters. So UK markets were plunged into fresh volatility as speculation about the budget heightened uncertainty over the nation's finances. A series of mixed messages about UK tax policy led to wild swings in gilts and the pound on Friday, with the UK's 10-year yield and 30-year yield jumping and the pound being lower. The volatility was prompted by conflicting headlines, including reports that Chancellor of the Exchequer Rachel Reeves was dropping plans to raise income tax at the budget and considering extending the freeze on income tax thresholds. So yeah, it's the uncertainty around the pound and the budget and the effect it's going to have really on businesses and investment is what is keeping the pound, on the weak side. Markets like certainty; they like to, know what's going on, or at least have a decent guess and forecast as to what's going on in the future. And so, with the pound being a lot of uncertainty around the pound, I think the pound, any pullback should really be shorting opportunities. You do have a level of supply right here. And so, for me, any pullbacks into this zone here should actually be decent for a sell trade. If it moves even higher than that, again, and there's still a lot of uncertainty around the effect of the budget, then I'm just looking for short trades at these areas. No real reason to buy the pound, although, of course, we do have data this week. I think it's CPI data, and CPI data could affect the short term movement of the pound if inflation is seen as being a bit more stickier or maybe rising a bit. Then the market may start to price out a little bit of rate cuts for December, but I don't know whether it's going to be that much. But we'll see how the market reacts to the data. So just to as a recap, for me, the dollar is a buy, more of a buy than a sell. The euro, you can look for buys and sells in the euro, but I think at the moment, technically, the euro can be a sell. The yen is a sell for me, and the pound is a sell. So when we're looking at the pairs, it's easier to now understand which way you want to go, long or short. So euro dollar for me, euro dollar this week come up to a really nice area of supply, and I think it should be a sell. You've also got a nice area, technical confluence of support and resistance, right? You've got support, bit of resistance there, a little bit of support on that wick. So here is a nice technically. And again, this is really based on the idea that the Federal Reserve are likely to hold rates. If they are likely to continue cutting rates, then of course this whole level is just not going to hold, right? The market will likely price out holds, price in more cuts, which would mean that the dollar would likely move to the upside. So again, this trade idea that I have is more based on rate holds being more probable than rate cuts. And if I'm correct, then of course the market should want to move to the downside. So now I'm just waiting for an entry. Not going to end. I didn't really want to enter on a Friday hold over the weekend, so I'll just wait for Monday and look for an entry to the downside. If you are looking for buys, of course, then you can look for a buy trade at these demand zones. That'd be decent for buying at the 115, around the 115.60s, 115.40s. The dollar yen, I think, should most likely will move a little bit higher. I think there are areas to look for buy trades. I think if we're looking for, yeah, probably maybe around there. If you're looking for a buy trade, I think a decent pullback will really be down to the below the 153, so around the 152s, this area here within this fresh area of demand. That would be, really nice. And again, it's quite a wide area, so when you see those wide areas of demand on the daily, all you do is go down to the lower time frame, draw out your levels of support and resistance, right? See where they are. For me, I think somewhere around this area here, the 15240s would be the better area. The lower this pulls back, the cheaper. And I'm not saying it will pull back, but that's where I would look to buy if prices present the opportunity. By the way, the higher this goes, the more likely there is to be intervention from the Bank of Japan. Intervention is where the central bank kind of steps in to try to either stem the depreciation or appreciation of a currency. And so, the zone really is from 155 to 160. So the higher this goes is the more you're likely to get some sort of spike. So um, when was it? It was last year. We got two interventions. I think one was around this April area where the central bank came in. It wasn't necessarily, it didn't last too long, and then I think we got another one. I think it must have been in July, somewhere around here. So again, the higher we move, is we're getting into this area where central bank, the Bank of Japan, doesn't want this to go too much higher, because a weakening currency adds to inflation, and they're trying to get inflation back down to the 2%, not higher, right? They don't want it to go higher. So for me, though, I think any pullbacks are buying opportunities. I wouldn't necessarily try and time any kind of intervention for the Japanese yen. The pound, I think the pound dollar is a sell on the on buying the dollar and selling the pound. So buying the dollar, selling the pound. But at the moment, there's not really much of a setup around here that I'm too interested in. I think prices would have to come up to this area here, right, or create some sort of stop hunt area, which would be around that 13218. So if there's a stop hunt on that lower time frame, then I would maybe look to get involved in that. But for now, there's nothing in terms of a setup. Euro pound, I would say definitely more of a long trade. Although the euro can be a sell, I think it's definitely in a much better position than the UK. So any pullbacks into this area here, I think is going to be decent for a buy. And or if prices move down even further and get a cheaper area to look for a buy trade around the 87.30s, then that's going to be nice for a buy. The euro yen again should really be on the long side, so any pullbacks should be decent. I think the nearest demand zone is going to be all the way down at this 177 area, so there's a good maybe 300 pips to 250, 300 pips for it to pull back. Sounds like a lot, but this pair can move quite quickly. So if you do get a pullback, and again the fundamentals suggest that the euro should remain more of a buy than the yen, then that's going to be actually a really nice area to look for a buy trade. And then we've got the pound yen, and I did take a short trade here, which again I'll get into when I get into the trade analysis. Again, break even trade, prices did continue to move to the upside, which actually just goes to show you how weak the yen is, because that was in the face of unemployment rate going higher, and I think GDP coming in lower as well. So month on month came in negative, growth rate quarter on quarter came in below forecast as well. So that really should have sent the pound weaker. But again, against another weak currency like the yen, unfortunately, the pound ended up appreciating. But it came up to a level where there was a second opportunity to look for short trades. But by that time, I just considered the yen to be a bit too weak to be really any kind to try and get in again. If prices move against me and there's another entry, and the fundamentals have kind of stayed the same, then fine. But when I entered here, I had assumed that the yen and the Bank of Japan were looking at potentially hiking rates, but then by the time I got into the trade, news started coming out about how the Bank of Japan were a little bit more dovish, the government, etc. So yeah, I'm not going to enter into that trade if the yen fundamentally is going to, is kind of switched up and remained on the weak side. So, but if you are looking for a trade on this pair, then I would say maybe somewhere down at these lows. I mean, technically, you do have higher high, higher low here. You could get involved if the prices do pull back down into this area. But for now, I'm not really interested in this pair at all. You could look for sells as well, which means that you'd be buying the yen against the pound. And I guess you could still think about the idea that, the uncertainty around the pound should maybe strengthen the yen. But I mean, at the end of the day, you might as well buy the Swiss franc or another currency like the euro to try and trade sell the pound against. So the yen at the moment for me, not really a buy at all. Looking at the precious metals, and then we did get a bit of a sell off on gold. Kind of just about touched or just nearly didn't touch the supply zone, but came close enough. Sold off, and again that's probably due to more the market pricing of rate holds for the US dollar, and again any kind of strength in the dollar will the market, the gold will end up selling off. So if you are looking for any kind of buying, you're looking to buy the dollar, you could look for a pullback up into this zone before looking at going short. If you are looking to sell the dollar and buy gold, then of course any pullbacks down into this area should be nice buying opportunity. Same thing with silver. Silver came up to this really nice high, really, really accurate, but then sold off on the Thursday. Could be again just profit taking, who knows. But ultimately, if you are looking for a trade and buying the dollar, selling silver, then you can look for a pullback up into here. If you're looking to reload and buying silver at cheaper prices, then of course a pullback into that zone there will be decent. And looking at the indices again over the medium to long term are typically driven by interest rates and in interest rate cycles. And so the news that there's potential for interest rates holds may be used as the narrative to for profit taking and for prices to kind of move even lower, right? But even then, to kind of put it into perspective, I wouldn't call this necessarily a crash or anything like that. If you're looking at this from a discount perspective, it's really about 5% discount, 10% discount. If you were looking to buy anything in the shops, you wouldn't even 5% discount isn't that much, right? But in terms of looking to trade this, I would say that's a decent pullback for enough potential upside if prices were to move to the upside, right? I think there's you do have a trend line here. Trend line breaks typically are signs as well that the trend is maybe ending, and we could be entering into a ranging market, a sideways moving market, an auction. Where buyers consider this to be expensive, but the last area that push prices to the upside is seen as a bargain price, right? So we could end up coming down to these 600 area, and maybe just a bit lower 6.5s before going higher over the next few days and weeks. But again, I think as long as the rumor that the Fed may hold rates, I think will definitely cap the upside for the S&P. So you could actually look for some short trades if prices move up here and the probabilities of a rate hold start to increase. That's the key to that trade to the downside. So looking at trade updates, so I did enter one trade. As you guys know, it was only the pound yen, and I'll break down the trade. So I entered on this supply zone on the daily time frame, and zooming in, my entry was I entered into 3 positions. So that was the entry right here, the initial one with my stop loss at the 203.6768 level. So that was the first entry. And then I got into 3 positions as prices pulled back. Now, what I typically do is I will double up the positions. So let's just say that this is, 1%. Yeah, the 50% pullback when prices pull back to here, it's 2%. And then as it pulls back into this 95% area, then that's 3%. So when prices pulled back, it triggered me into all 3 positions. All I really need is basically just one of these trades, this 95% trade, to hit a one-to-one target for me to then get to a break even, right? Because if I win this position, which is 3%, then I've only got 3%. 1 plus 2 is 3 in the market. So I'm basically at break even. If, for example, I get triggered into 2 positions and win this one position, that position there, the 50% retracement, and lose that one, then I'm actually up, make money, because I would have won 2, lost 1. So that's the way that I do it. And so yeah, basically when prices came up into this area, triggering me into all 3, you can see this position here ended up coming down and then just clipping my one-to-one, which meant that I got into I took that profit off there, then had only these 2 profits, these 2 open positions, unrealized profit. Unrealized profit was is an understatement, but yeah, I only had these 2 positions, and then prices ended up going against me. But again, overall, it was a break even trade this week. So yeah, that's it. No money made, unfortunately, this week. But again, we've got the rest of our lives to trade. So this week, break even, and I'm not looking really to kind of re-enter this position at all until something materially changes with the pound and the yen. I've got my eye on the euro dollar and maybe 1 or 2 other trades. So let's see how those set up for the coming week. And yeah, that's about it. So all take care. Have a great trading week, and I'll see you next week.